Time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Westin, joins us as he does every day at this time. And we all woke up today, David, with a closer look at third quarter GDP. And it surprised a lot of folks to the upside here, sizzling hot.
How about that?
Yeah.
Including a lot of economists.
Absolutely.
So we're not predicting that at all. So we brought in an economist to try to correct us all, tell us where we went wrong. He's Paul Romer. He's Nobel-winning economist and professor of economics at Bostick College. So, Paul, thank you so much for being with us. So what happened? I mean, so many people, including a lot of economists, never thought we'd be at 4.9% in the third quarter.
That's the message. Nobody expected this. If we look back, we had inflation that went up during COVID. The Fed raised interest rates. Inflation's come down very consistently, so that was kind of expected. What didn't happen was unemployment didn't go up. Growth didn't slow down. And everybody thought the theory was you could only bring inflation down when the economy slows. And that just is not true right now. So right now we're at a period where we got to just look at the facts and not be, confused by some theory that turns out to be wrong.
Well, was everybody wrong? In fact, can we bring inflation down and still have this much growth going on? Is that possible, do you think?
This is what the facts are showing us right now. Now, will it happen the next time we have a bout of inflation? We don't know. But it's clearly what's happening right now. We've had 12 months where every single month, except one, 11 out of 12, you compare it with the inflation rate a year before, and it was lower in the past 12 months than the ones before. And you add up the reduction, we're down by like 2.4% over the last 12 months compared to the previous 12 months. So a really big, very consistent reduction in inflation that nobody thought was possible in an environment of steady growth and high employment.
It raises the question, though, as to sort of what sort of caused the inflation in the first place, because there was a lot of discussion that if some of the uptick in inflation was indeed much more related to the pandemic and the supply chain issues, that once that sorted itself out, you can end up in this kind of, for lack of a better word, that soft landing scenario.
Yeah, I think that's right. So we might have periods of inflation that are like the one we're in. We might have other periods of inflation that are kind of like what we got into in the 70s, where expectations are not anchored and it's a much more complicated process. But the point is that we need to recognize we don't know, and we need to just feel our way along in the dark now. Look at the facts and don't assume this one's going to be like the last one.
It gets to the question, though, as to how much room the Fed has right now to sit by and wait, right? Because there's going to be a lot of pressure on them to do something, either raise again or even, as some people want to see them cut. Is there an incentive for them just to say, this is it, we're just going to stay here?
No, I would take it one step further.
What's that?
If you look at, say, the most recent 6 months versus the previous 6 months, what's been happening, and this has been true when I looked every month for the last 6 months, the most recent 6 months, inflation's been falling faster than before. So we've not only started a decline in inflation, but it's a decline that's speeding up. It's like a descent that's getting steeper. You need to look forward and say, pretty soon we're going to be where we want to be. So we got to start pulling out of this dive. I think it's time for the Fed not just, it'd be crazy to raise rates at this point. I think they should start cutting rates and explain to people, within a year, we're going to be at our 2% target. We need to sort of get ready to level off because we don't want to keep descending when we bust through our, our target level.
Well, what about that? The Fed had something to do with bringing the inflation down. I think it was, record fast pace for 550 basis points, right?
And let's emphasize that. They increased them 500 basis points in 5 quarters.
Yeah.
And I think they deserve credit for moving aggressively because, inflation was high and they needed to do something.
But there's a debate going on among economists right now whether, in fact, we're going to go back to the regime of lower interest rates, the way we had it for so long, or whether they're going to be more permanently elevated for a whole range of factors. And actually, our colleague down in Washington, Peggy Collins, talked with Secretary Yellen earlier today, and this is what Secretary Yellen had to say about that question.
Interest rates over decades had been coming down, real interest rates, and that there were deep structural reasons for that, in part relating to demographics. And those underlying trends, they're still there, they're still in force. So I think it's perfectly possible that we will see longer-term yields come down, but nobody really knows for sure. But I see the higher yields as certainly importantly a reflection of a stronger economy.
So I want you to check another economist's paper here. Is she right about that? Because demographics are not continuing to grow. Certainly the United States, Europe, Japan, even China.
Listen, if Janet were a student, I'd give her an A because she said exactly the right thing, which is we don't know. It might be that we're going to return to those lower rates from before. But she didn't say, I'm certain of that. So I think everybody right now needs to be in this, let's feel our way along. Let's look and see what the numbers show. And the other thing I would emphasize is it depends a lot on what the administration can do. It might be that in a better world, they keep passing new infrastructure bills. We make progress on clean energy. We make progress on transportation, all the things we need to do. So lots more fiscal policy. That might mean we need to have slightly tighter monetary policy. So it's a little bit like back to the future of the Reagan era of loose fiscal policy and tight monetary policy. If that means like slightly higher real rates, I think that might be okay.
Well, but she also was asked about that as well, and she did express some concern about the current state of fiscal deficits and how that feeds through here into, I guess, the ratios that she feels she's comfortable with. I think she cited 2% on a real adjusted basis to GDP.
Yep. Well, so if you go back to when macroeconomics was sensible, it kind of went crazy for like most of my career, but you go back to when it was sensible, we had a notion of the balanced budget multiplier. There's a way to spend more and to raise some additional taxes, but you still get stimulus on net from X dollars of additional spending and X dollars of additional tax revenue. We've let the tax system, deteriorate, and we've let people not comply, and we're not collecting as much tax as we need to. But it's perfectly possible to keep, making these important infrastructure investments, and to collect enough taxes to close these budgets, and still provide stimulus.
Well, I mean, it's funny you say macroeconomics has gone crazy. We should point out, I mean, Congress has gone crazy too. I'm not sure that we're going to get anything sensible for a while. But I mean, that raises a challenge for a policymaker like Yellen, or whether you're talking about a monetary policy maker like Powell here. What becomes the next step? I don't mean in terms of just raising rates, but really the overall structure of how they sort of shape policy for what is going to be a new era that Yellen herself said is going to be higher for longer, but still with a lot of elements of that low rate era.
Yeah. I think Powell is on the right track when he says we're going to follow the data. I think he could be much more explicit with people about exactly what he's looking at, because he hasn't, and people around him haven't said something like, look, 11 out of the last 12 months, we had an inflation rate that was lower than a year before. So we're really coming down. And it's been coming down faster in the last 6 months than it was before. So we need to start leveling out, because we can't keep making the dive steeper. I think he needs to talk about these facts instead of just project like toughness or something.